Hello, everyone, and welcome to another weekly video update. Now, we have a lot to talk about in terms of the macroeconomic outlook. We got a lot of interesting data coming in regarding treasuries, of course, also jobs reports. So definitely a lot to talk about and a lot of movement in markets. Now, so let's begin, of course, by looking at the new schedule for the US Treasury debt issuance, which, of course, has rocked markets. And we've seen, 20-year treasuries go above 5%. And it's quite interesting, of course, if we look here, we can see that in August, the Treasury will sell 270 billion in notes and bonds, up by 24 billion from July. The Treasury Department said in its quarter refunding statement today, Treasury plans to increase auction sizes by slightly larger amounts in certain tenors in order to maintain the structural balance of supply and demand across tenors. Treasury will evaluate whether similar relative adjustments are appropriate when determining auction size changes in future quarters, okay? And we can see here next week, Treasury will increase the auction size of notes and bonds by 13 billion from July to 103 billion. 3-year notes, 42 billion. That's an extra 2 billion from last month. 10-year notes, 38 billion. And then 30-year bonds by 23 billion. Okay, so pretty much as the title here quite aptly describes, a tsunami of longer-term Treasury notes and bonds. Okay, so basically, we've got the federal government beginning to issue that large amount of debt, okay, getting really in the trillions, the Bidenomics really taking hold here and kind of rocking markets. So we've seen treasury markets react quite wildly to this. So if we move, for example, to the 20-year treasury chart, so we can see how basically we're now retesting the lows that we struck back in October, okay? So in terms of the yield, this is actually now getting close to about 4.3, 4.4%. And we can see here in the chart of TLT, this shows the face value, of course. So this chart going down, basically, the bond losing value, of course, means the coupon, the interest rate on those are higher. And, basically, we did try and make some Elliott wave analysis on this. And we can see here that we could have argued that there was a low struck here in a wave C. Okay, in fact, if we look at the longer term chart, we can see this was all part of a larger kind of diagonal. Yeah, taking a read to the edge there, we can see finding the support on that trend line. But, now with this latest breakdown, really, we are threading to go even further down. Now, if we zoom into this more recent action, we can see that the TLT has broken down from this kind of descending wedge that we were forming, and it's now kind of finding support around this level, around that $96, $95 level. And if we actually measure from here, we're pretty much, sort of at the last kind of level of resort in terms of Fibonacci level. We're pretty much at the low struck in the wave 2. So honestly, this is looking like it could certainly head even lower. So this is something that, Bill Ackman famously came out in the last week saying he was shorting the 30-year treasury bonds. And, it certainly makes a lot of sense here from a charting perspective and from a fundamental perspective with all that debt kind of coming in. And we'll definitely see how this affects markets, because it's definitely going to have some interesting effects. Now, in terms of macro data, we also got some employment data coming out. Of course, unemployment still acting pretty resilient, but I wanted to point out this tweet by Eric Basmagian, who I'm actually going to be interviewing on the Investing Expert podcast at some point later this week. He mentions that if you actually look into the numbers, 60% of monthly job gains are coming from government, education, and healthcare. So all the labor market narratives are illusion at best and misleading at worst. Okay, so kind of interesting seeing that breakdown and, kind of, I think, hidden in the numbers here, even though definitely we're still seeing structurally low unemployment, definitely something a little bit hidden there. Now, moving on, I also wanted to share these charts shared by Darius Dale. So this was shared on the Anthony Pompliano podcast. And here he talks a little bit about PCE, right? So we also got some data with the jobs numbers. We also got, of course, some data on personal income compensation. And we can see that this has begun to trend up quite significantly in the last 3 months here. So if we look at this first panel here, personal income compensation on employees received. okay, and we can also see quite a big bump if we look at personal income, personal interest income, okay. So Darius Dale, of course, here continuing to make the argument, which we also went over a couple of videos ago, that the US economy is a lot more resilient. And of course, that means that the market should continue rallying. So with that said, I do subscribe to the narrative, portrayed by Darius, that the economy is resilient. I also see, what Eric is talking about in terms of those numbers being deceiving to a certain extent, and obviously kind of expected, to see that big concentration of job creation, in government, at a time, of course, when, Biden will be up for re-election. But I wanted to basically now talk about 1987. And this is also an idea that has been talked about by another macro investor I like to follow, and also fellow Seeking Alpha contributor, Michael Gayed. I believe that's how it's pronounced. So he's been talking about the idea of this being a bit like 1987 and that kind of credit event, which, of course, in light of the recent moves in Treasury, is kind of beginning to make a bit of sense, right? And so I wanted to look at this period and kind of compare what we're seeing now with what we saw back then. So it's interesting, obviously 1987 referred to now as Black Monday or Black Tuesday, of course, depending on which country you were in, that stock market crash might have happened on a different day. But that's basically when we saw, as we can see here, the S&P kind of lose about, let's see, we went from about 330 all the way down to about 217. So pretty significant sell-off there. And, there wasn't particular recession happening, right? So if we actually look at unemployment here, you can see that the unemployment rate had been steadily falling. In fact, it'd been falling quite noticeably since about 1986 over here. And then on the other hand, what we had here was the Fed funds rate, which had also been coming down. Of course, leading up to this crash, we did see the interest rate kind of start to tick up. And interestingly, we also saw, of course, inflation begin to tick up. Okay, so obviously, this increase in the interest rate was actually a reaction of this kind of uptick in inflation that we can see here in the yellow line. Now, that might have been the catalyst that began the sell-off, but this was actually made a lot worse by, we can see here, computerized trading and portfolio insurance trading strategies. Okay, so basically the idea is that once the sell-off began, and computerized trading, kind of high frequency trading, was kind of new. Basically, that helped exacerbate the sell-off, right? Where these basically algorithms were beginning to trade, let's say, the momentum, and basically exacerbated that sell-off. Now, since the 1987 crash, there have been a lot of regulations taking place, to stop this kind of thing happening again. But with that said, we do have a new financial product, well, relatively new, which of course is those 0DT options, right? So options with that expire at the end of the day, and those have really been going up in terms of usage. So as we can see in this chart, 0DT options have really spiked in the last basically couple of years, right? We can see here, well, actually a little bit more starting 2020, and we've seen this spike, especially starting towards 2022. So we can see here the 0DT options as a percentage of the SPX volume, and we can see that about 50% of options traded in Q1 of 2023 were actually options that expired on the same day. Okay, so again, it's kind of interesting, and it's been floated around that this could be kind of the act in the same way as computerized trading kind of led to that sell-off in 1987, that we could see something similar happen now with those 0DT options. And just to finalize, so we do have, like I said, those kind of, you could say, parallelisms there in terms of, on the one hand, unemployment actually coming down. Okay, so my first point here is that we can sell off even without a recession, right? So that is possible, and something to take into account. Now, the other thing is that, of course, basically this sell-off could also be arguably explained by this kind of spike in interest rates, right? So kind of the market probably not expecting inflation to recover. And this is something that I've been talking about in my previous post, the idea that inflation could definitely become a little bit more resilient, especially as we've seen, and kind of as we expected, as we've seen those commodities really start to rally in the last month. And finally, from a technical perspective, of course, we can see that, we were basically building pretty large divergence here in the RSI on the weekly charts. And, this is something that arguably we could be building soon as well. Yes. So looking at this chart, of course, unemployment we know is near all-time lows. Now, I do expect this to, begin to creep up, but like we know, obviously in terms of a recession, nothing too worrisome there. But of course, that doesn't mean that there's not going to be a sell-off. Now, the Fed funds rate, of course, has come up to about 5% here. Now, of course, over the last year, we've had one of the most aggressive tightening cycles we have seen, but yet the stock market has rallied, and that has been, of course, kind of on the back of this, immaculate disinflation. But like I said, I think that, we could be in for a bit of a surprise, and that's really what could spook the markets. And, to that extent, if we look back at the 1987 chart, we could see that the sell-off that we saw actually led us down to about the 200 weekly moving average. So that would put us around 3,880, so about 3,900 in terms of the S&P. So that's definitely something that I'm looking at right now, especially since, in terms of our eyelid wave structure, we're getting towards the top of this wave 3. And I'd expect at least a pullback to around the 4,200 area. But again, even within this bullish count, we could see a significantly deeper pullback into this area. Okay, so that's not something I'm discounting. The only thing is that in terms of it from a technical perspective, we're not seeing this divergence in the RSI yet. So actually, and kind of again in line with my Elliott wave count here, I'd expect to see us rebound here and kind of reach these targets around 4,700, 4,800, pretty much kind of almost a double top. And at that point, hopefully kind of we'd begin to see that divergence, right? So we'd see the S&P on the weekly chart make some higher highs, and on the other hand, the RSI begin to make those lower lows. So once we had that in place, I would say that's definitely a very good setup for a big sell-off in the S&P. And now moving on to the Bitcoin chart, we can see here on the 4-hour chart that we have slowly sort of grinded down, trying to reach our target box. Of course, Bitcoin pretty much stuck in this very, very tight range. And, my expectation here hasn't really changed. I still expect us to break out to the downside on this range and really kind of challenge that $28,000 level, which should act as support, right? We have the 50% retracement of this rally coming in there. And if we look at the VPVR, I think we also have some significant support there. So this, of course, 28,000 was an important area of trade around here. And so it should really come in as a strong area of support. Of course, once that is reached, we should expect us to at least make a higher high, kind of, again, depending on which count we're on. So I do present here two possibilities. One is that, this was all part of 1, 2, 3, 4, 5, which would end us here. And alternatively, though, this could be more of an ABC in a wave 1. This is our wave 2, and our wave 3 actually would take us much higher. And this would just be the beginning of a much larger rally. Now, looking at the NDX and, what I expect for the stock market, I'm kind of favoring this idea that, we might actually see a much bigger sell-off leading up to the halving. And of course, this would also make a lot of sense in terms of that Bitcoin halving cycle dynamics, which we usually observe, right? Which is, we see that kind of big pump leading up to the halving, then a little bit of a sell-off, and then really kind of, as we approach the halving, into the halving, really start to take off, okay? Kind of like we saw back here, right? Now, of course, this was also due to the COVID crisis, but basically this is what we saw, right? We saw big rally here, wave 2, which retested almost the lows we made back here. And then really, as we really entered the halving, we got to those new all-time highs. Now, looking at the oil chart, we've actually gone kind of beyond the levels that I was expecting, right? So if we look at the Fibonacci levels, we're actually now close to tapping the 2.618 extension, nothing impossible there, but, a little bit more than you'd expect. And we've actually broken through these previous highs. So, again, not that much resistance in terms of volume now, but nonetheless, I would expect us to pull back here at least to maybe around 69, 70. Okay, so if we were to say that this was the top of wave 5, then retracement into the $68 area would probably be quite expected. And to that extent, I mean, we are seeing the RSI now kind of really getting into the overbought territory and maybe starting to give us a bit of a divergence here. So definitely I'd look into maybe buying down here. Of course, natural gas is one that we've been looking at, UNG in particular, which we have a trade on. Now, of course, this did go a bit lower than I was expecting, giving us that lower low in wave C, but we rebounded very well from there. And basically now that we are kind of above that 50-day moving average, we are kind of ready to get back in here and really kind of break out from this triangle, which we've been forming since around June. And that should really help us rocket into this $10 area that I've been looking for. And let's not forget silver and the metals too. Now, I am focusing a bit more on the silver chart. I think it has a little bit more potential. And it's interesting to see that silver here went below the 50% retracement, kind of in between the 50 and the 61.8% retracement. It also broke below the 50-day moving average. So momentum is certainly more to the downside, but we did see a couple of green days. And in any case, this is kind of our reversal zone, right? This is where we'd expect to really begin to take off in a wave 5. And of course, my target for that is around the $23 area. So, pretty substantial rally in silver could be here. So, not a bad opportunity to go long silver here if you haven't already. And just to wrap up, looking at the dollar charts, it's going to be very interesting to see where this heads. Of course, we got that breakdown that we were expecting. Now, the question is, though, can this breakdown continue, or are we going to see this continuation to the upside, right? Now, we have failed to breach the 50-day moving average, and we're still below this trend line support. So this is really the setup for lower. I believe that, if we turn up from here and break above that 50-day moving average, then we are definitely going to see much higher. A really pivotal point because, as we know, dollar very inversely correlated with the risk assets and Bitcoin. So we really need to see this go lower if we want Bitcoin or NDX to go higher in the more immediate term. And that's all for today's weekend report. Coming up, we'll have the CPI data, which we'll be keeping a close eye on. So stay tuned.